The screen okay? Everyone see my screen that I'm sharing? So day 3. I don't even know what day it is. Day 3. And day 3, session 2. We've got so much value lined up for this session and the next session. And I hope you guys have got value to this point. I hope you've kind of appreciated how it's built on, each session is built on the other. And we're really trying to take you through the process so that we do fill in all those gaps as we go. So by the end of this, by Friday or by Saturday, when some of you guys are going to actually meet up with me and some of the other traders, we can all talk about how your confidence and your clarity and your enthusiasm for your new the new chapter of your trading journey. So that's been really the focus for this whole event. So great practical session again there with Akil. Again, I want to start now talking about a bit more to do with performance. And what I'm going to share with you in this session, you probably won't hear anywhere else. I don't see anywhere talking about this level of performance optimization, this way of thinking about trading, this way of managing your trading. And although tomorrow we're going to be talking about the back end and money management, and we're going to be sharing with you some some tools and some processes that we use for actual position sizing and tweaking and optimization, what I want to share with you today is really one of the most important lessons you can possibly learn in trading, and that is your performance, how to review your performance, how to get better as a trader, how to look at trading, how to look at profit and loss. I'm going to talk a little bit about the business side of it. And this is stuff, as I say, it's probably the most important thing you're going to learn, but no one talks about it. And also, the reason this is so important is because trading is a business like any other business. And I've spoke to you many times before and told you guys that I've worked with traders on their personal finance, traders that are earning 7 figures. I met a trader in Vegas in 2019 who was earning 7 figures and wanted to work with me to teach him how to manage his money because he had nothing every month. So earning a lot of money is one thing, managing your money and controlling your business expenses and how you monitor your business financials is another thing. And trading is a business, and that's what I want to talk a little bit about in this session and talk to you about how to review your strategy. Now we've learned how to develop a strategy. I want to give you some insights on what I do to make sure that I'm approximating the best development towards my edge as possible. Okay, so I'm going to be telling you how to review, how to optimize, things to take into consideration when you want to make your system even more profitable. So without further ado, we will get stuck in. Making money is one thing, being able to keep it is another animal. Yeah, I mean, I work with lots and lots of millionaires who come, you guys have seen my social media, right? There's literally equity millionaires, people who are earning millions and come to me because they've got no idea. It's very, a lot of people are good at making money. Very few people are, but a lot of people are also good at spending money and not managing it. So make sure you've got that differentiator there. Make sure you understand that, because trading is a business. You're going to have to manage it like a business. You're going to have to pay tax. You're going to have to, you're going to have to compound your account. You're going to have to reinvest some money into your account. You're going to have to make sure that you're identifying any downsides to your strategy. The things that are causing a death by 1,000 cuts, any bleeding, you've got to stop that, and you've got to be able to identify that as well. Back testing, I get some profits, but as soon as I go live, I fail badly. That sounds like a mindset thing, which we can work on. Charles is going to do a great session after me today as well. Oh, sorry guys. I'm doing this new training regime and it's definitely making me more tired. Anyway, your trading business. Let's talk about that. So, your trading business. First things first thing I want to do is open your eyes to business in general, because everyone's saying that there's a high failure rate in trading. And I'm telling you that trading is a business, and you're thinking, well, okay, that's two things that have got a potentially high failure rate. But for some reason, people think that trading is this very risky, very, very high failure rate thing. And the tragedy in that is that they think it's down to the skill. And it's not actually the skill. It's not actually the skill of being a trader that causes that high failure rate. It's the approach and the lack of knowledge on how to manage your trading business. That's what it is. And the emotions and the psychology and all the other stuff, that's why it's a high failure rate. It's not a high failure rate because it's difficult to do, because it's definitely not difficult to do. The actual technicals of trading, as I said, you can learn it in a very relatively short space of time if you put in the work, which you can't do in every business. If you want to be a master carpenter, you can't learn how to do that in 6 to 12 months. You can't learn how to be a lawyer in 12 to 18 months. You just can't do that. So it's great in that way, but it is a business, okay? And we have to treat it like a business. But let's look at the stats, because if you're thinking trading is risky, I can tell you that 90% of businesses, any business, fails within the first 5 years. Okay, 90% of people that start businesses, this is a statistic, fail within the first 5 years. And then from 5 to 10 years, 90% of those fail. Right? So out of 100 businesses, say, you're going to end up with 5 businesses, 2 businesses, something like that at the end of the year, at the end of the 10 years, still going. So it's not just trading, it's all business. It's all businesses. So what I want to talk to you about is what the most important thing in business is. Now, does anyone here run a business? What is the most important thing in business? You guys let me know if you know the answer. Profit? Yeah, right, okay. Customer service, cash. Yeah, right, cash. Number one is cash, because before you even, I'll tell you why it's number one, because before you even go to make a profit, you want to keep costs down on expenses and production. All right. So I see a lot of business owners go out there and the first thing they do is spend tens of thousands on a website and business cards and a launch party and merchandise and all this kind of stuff before the business is bringing in a profit. And it's a very inefficient way of building wealth, let alone, running a business, because you're just bleeding the cash unnecessarily. Now, don't get me wrong, there's a time and place to spend money on things like that, but it's not before you've even brought in a profit. Then once you are bringing in a profit, cash flow is king. And unless you've run a business and you've woke up in the night sweating, worrying about how you're going to pay your employees, you won't really understand what I'm saying. But trust me, it is. And the volatility of cash flow is something that is extremely important in business, because it allows you to grow, it allows you to be more creative, it allows you to feel more free, and it allows you to make better decisions. It allows you to deal with more chaos, deal with more logic, be more creative. It's just absolutely crucial to monitor cash flow and have good cash flow in your business. So as Warren Buffett once said, rule number 1, never lose money. Rule number 2, never forget rule 1, right? And it's true. And the reason that most businesses fail is down to cash flow. It's down to cash flow. Now, here's some other stats that I found really interesting. This is the UK, by the way. 25% of all businesses employ someone. Okay, so that means that 25% of businesses, only 25% of businesses employ someone. So if you are employing someone in your business, you're in the top 25% of all businesses, okay? Then 45% of businesses cross the VAT threshold, meaning they get to above £87,500 per year, but only 3.5% of all businesses employ 10 or more people. So that's tiny, right? 3.5% of every business employ more than 10 people. And the reason that they struggle to get to the VAT threshold or employ someone else or get to 10 people is why? I can tell you. Cash flow. It's cash flow. They don't have cash flow. They haven't got cash coming in, or they're not managing the cash flow out correctly. And that's it. So there's no growth. There's no scalability, and they end up on a hamster wheel. Okay? And they end up doing all of the jobs in a business, and they become very resentful. So what I want to do is talk about the performance of business, because I want to talk about the performance of your trading. But before I get into that, I just want to share with you some kind of contrasting examples of other business models. So, because if you run a shop, I think COVID-19 has really opened your eyes to how running a shop cannot be the best business model for you. Okay, one, it's in a fixed location, usually. Two, it's got, you have to show up during open hours, and you have to hope that people walk past the shop and come in and see the sign. Okay. Three, there's no way of building any real rapport with anyone. And for that reason, it's a very low success rate, and you need a lot of cash, a lot of liquidity to dump into that thing. And then you'll need to open a shop, which is going to cost more cash. You're going to have to train staff, which is more cash. And this isn't the best use of cash. Okay. Then another thing is a trade. Many of you guys are in a trade of some sort. I know there's a lot of IT guys. I know there's a lot of electrical engineers. I know there's a lot of military. I know there's a lot of people who have got some kind of trade background. And again, very low success rate. It's a service-based business, which is very, very difficult. It's hard to manage cash. You need tools, vehicles, you need all that overheads. And you've got a very, very active income of, based on stats, from 45 to, let's say, 100,000 a year, okay? But bearing in mind, 25%, 75% of business don't employ a second person. So with that comes tiredness, resentment, doing the paperwork, all that kind of stuff. So it's very, very tricky. Now, with a trading business, the great thing about this, and where this really comes into its own, is it's very low startup costs. You don't have to have any staff. You don't have to have any shop. There's no rent to pay. There's no buildings. There's no products. There's no drop shipping. There's no suppliers. There's no shop fronts. And the business plan is something that can be tested in black and white with proof. Okay? And although it's still dependent on you to go and execute your trade plan, which we've been over, there's very little and very few businesses that allow you to produce a trade plan or a business plan that is very, very predictable and likely to happen and has a high probability of playing out. Because with other businesses, it's all down to trends and how people's demand changes and staff not showing up and employing the right people and trying to and changing trends and all that kind of stuff. With trading, you don't have any of that. You have patterns that represent human evolution and psychology that have got predictable patterns in them, which we can create rules around, which we can skew our reward to risk in our favor, which we can see when they happen frequently, so we can build systems that happen all the time and are prolific in certain situations in the market. And then we go and test it. And we go and test it, and then we see the results, and we know what we're dealing with going forward, and we know that what we're likely to return if we just trade that trade plan flawlessly. And remember, I said that, flawlessly, because I'm going to talk about how to trade flawlessly in a moment. If we can do that, do you think that is a risky business? Bearing in mind everything I've just said. You've got a plan that will play out as long as you can perform. It's only reliant on you. and you've got none of this stuff. It's probably the least riskiest business I've ever been part of. The tough cookie to swallow is that it's all on you. All right? There's no blaming the staff. There's no blaming everyone's gone vegan. There's no blaming, oh, people just went off and did me on cancel culture, right? There's no blaming staff who's got the bus always late or the train's always late or the alarm clock never goes off. There's nothing. There's nothing to blame, which is why it's so hard for people and why we see so many bitter people who end up giving up or chasing some other system, and because they can't bear to blame themselves, they then start going, oh, that doesn't work, I'm going to go and do this. Yeah, what they were teaching me didn't work, I've seen so many. And the truth is, you can't hide from the fact it's on you to make a system profitable, as I explained yesterday. Who's confident here that they understand the concept of taking some ideas and building a strategy that's profitable now? And who's really excited about doing that? Who's confident that they understand and grasp that, and they're confident they can go and do that? Because that's really what we try and do here at Tier 1, is give you the fishing rod and say, this is how you fish, instead of just giving you fish. So you should feel a little bit more empowered by being at this event, because you know you've grabbed it by the horns. It's like, I get it. This is what trading is. This is about how to trade, not what to trade. It's about how to be a trader. Great stuff. That should be inspiring to you. That should be motivating to you. And you should be filled with enthusiasm for your future in trading. Coupled with the fact that, we've got a very attractive business model here, that should be the nail in the coffin for you guys to really, really go and, you owe this to yourself, no one else. You owe it to yourself. That no one else cares if you're a profitable trader or not. All right. So we're on day 3 now, so we're going to be a little bit more cutthroat, but I want you to get that. The other thing I want you to understand is there's always a cost of doing business. Always. Always a cost of doing business. So let me just show you a little graphic here that will kind of shift your mind into getting it, really understanding it. In a regular business, let's just say that we make gizmos, and I sell you a gizmo and I take your money, right? Which is the sale, which is that blue bar here. Now, that blue bar just represents the cost, the sale, okay? But to produce that sale, I've had to spend money on manufacturing, packaging, logistics, postage, staff, fuel, whatever it might be, okay? And to get that thing to you as a unit cost of, let's just say, $1,000, I sell you a gizmo, in that is an overhead charge of all of that. Might be my rent on my office. It might be the equipment I need to make the thing, right? The manufacturing, the factory, whatever it might be. So let's just say on average, there's a 30% profit. Now the profit is what goes bottom line. You pay tax on that. In the UK, you pay corporation tax on that, and then you pay tax again when you pay yourself and all this kind of thing. But you get about, on average, 10 to 30% profit is a healthy business here in the UK. On a service-based business or a widget-based business, all right? I'm not talking about Apple. Apple would be 3,000%. But that's about branding, and we'll talk about that another day. But that's how a regular business works. You make a sale, you pay the overheads, you get the profit. In trading, it's exactly the same. Okay? It's exactly the same. You've still got all of your winning trades, which make up the sale cost or the money in. Then the overheads are the losses and the equipment and the trading platform and the broker feeds and the technology or your electricity, your broadband, whatever it might be. And when you deduct one from the other, you end up with a profit. Okay? Now that profit might be 10%, 20%, 30%, 40% per year. And this is where it's really difficult for people to grasp, because the reason it's easier to grasp in a regular business like this is because you're getting a sale, you're covering the overhead, you're getting the profit, and you know unit by unit what you're likely to bring in, so you can pretty much feed a family confidently because you know how many you've got to sell, right? With trading, you don't get that. With trading, you might have a series of losers and a series of winners and then a series of winners and then a series of losers, and then you might have win, lose, win, lose, win, lose, win, lose. It's very sporadic. You can't, this is why I always say, guys, you don't know if anyone is telling you can earn a certain amount of pips per day or money per day, run, because it's impossible. And if you haven't, hopefully, if you haven't grasped that by looking at going through this workshop just to today, I don't know, you probably won't grasp that. So it's probably best that you just pack up. But you guys are really good. Like, you guys are probably one of the best groups we've had on one of these sessions in terms of engagement, high quality questions, high quality replies. So I'm taking it you guys get it. So that's why we have to focus on profit over time, and that's a little bit difficult for some people to do. They think, well, I want to start making an income right now. I need to live on this income right now, so I need to make this much now, and I need to make this much per month. When actually, in fact, you have to give yourself some time so that you can divvy up the profits over a length of time, a period of time. And of course, you're going to want to keep profit in the account as well. So that means you want to probably half the profits and then divide that up into the length of time. And then you can comfortably take that income out and know that, one, you're going to continue to grow your account. Two, you're going to, you're not going to run out of money. You're not taking more than you need or is going to affect your account. Now, when most people go into trading, you guys have heard of the J curve. I've spoke about this at every single event, I think. But this is what we see most common. A J curve business is when you put a load of money into something before you've got it off the ground, and then you start making profit, and then it's exponential profit. Okay? Very common, like a coffee shop or a tech business where they get a lot of funding and they get a lot of investment. They pay millions into the development of the thing, and then they launch it, they start bringing in profit, and then the profit's exponential because of the reward to risk, the cost, the profit. Okay, so in trading, what we see, and even in the coffee shop analogy that I always use, is people put a lot of time, effort, and money into getting to the point where they open the door to the coffee shop. They've employed the staff, they've trained the staff, they've bought the equipment, bought the coffee, done all the furniture, done all the training, done the marketing campaigns, the open party. They open the doors, and on day one, that's when they start bringing in the income. What most traders do is they put all the time, effort, and money into this. It's them on their own. They go and do some testing, or they don't do some testing. They go and study a strategy. They go and do the best they can to try and start earning money. And on day one, they go, this isn't working. This isn't, this is too much hard work, or this isn't reacting as I thought it would, because I increased my expectations in my back testing and not decreased my expectations in my back testing. So they become discouraged and they go, do you know what? This doesn't work. I'm going to go somewhere else. I'm going to go and learn something else. And they go and learn something else. And they do it all over again. Let me tell you that if you're in that position, you better have a lot of time and you better have a lot of money. Money that you can literally just burn. Because it is the biggest tragedy that we see in trading. Now, of course, when you actually come out the gate and you're consistent and you allow that compounding effect to take place, the profit's exponential. The results are exponential, the profit's exponential, your performance is exponential, and that's what I'm going to be talking about in just a moment. So, one more note on that before I just go into performance is make sure that you're not taking on too much at once, okay? Because a lot of traders think they've got to trade 100 markets, 20 markets, 30 markets, and they tried 10 strategies all at once. If you try and do that in any other business, you'll fall flat on your face. You know, you wouldn't manage 100 people, 10 people at once. You work your way up. You manage one until you can macro manage that person, then you take on another person, then you macro manage that person, you take on another person. Think about your pairs and your markets as employees. That's the best way to think about them. Be sensible. Don't take off too much than you can handle. Bring them in one at a time and make sure that you understand your system and your performance, like back to front, blindfolded. So the other point in business is there's always a performance review. Do you know any business that doesn't do a performance review of some kind? Even if it's just the business owner going, what's the P&L? How many sales do we make? What went well? What went poorly? There's not a business that doesn't do that. And if there is, it falls into the category of one of those that fails within 5 years. Okay? They don't go very far. They don't get very far. Government jobs. Even government jobs have a performance review. Might not be a very good one, but they do have one. And you know, at the end of the day, they don't have the risk of failure, right? They're not laying asleep at night. They just get paid the taxpayers' money. So that's a slight caveat. But there's always a performance review in a good business, okay? And we want to build good businesses, right? So I want to talk to you about development. Now you want to get ready for some notes here because I'm going to be going a little bit quick. So in order to remove distraction, I want to take my ugly mug off of here. I want you to get a pen and write all this down because this is stuff that you won't see anywhere else. No one talks about this stuff. All right, and this is going to be the key to being highly profitable in your trading as efficiently as possible. Okay? So as I say, this is not popular and it's not sexy, but we're going to cover 4 different components of continuous development in your trading. I've done it before. You guys that have been to our events before, you've probably seen this already. I'm going to go through it again because it's very popular. We often get asked to repeat this stuff because you miss it the first time round. So as long as you got ready to take notes, this should definitely trigger some light bulb moments. So the 4 things I'm going to cover is journaling, all right? Trading as a business, what to record, and the frequency that you record them in, etc. Plus, I'm going to talk about some methods. Figure focus, which is analyzing the numbers, knowing your numbers and projections, what to focus on, what not to focus on. Then we're going to be talking about analyzing your maximum loss trades, okay? Where you're taking bigger losers than you should be, analyzing any errors in your execution or your trades, okay? And analyzing any missed entries, which is very common in retail trading because people have different lifestyles. They're trying to build plans that are not suited to their consistent, execution, which I told you about on day 1. Very important to build it around your lifestyle and your personality. If you've got any questions on that, please let us know. And then 4th one is aggression discretion, which is, how to slowly and sustainably build discretion in your trading so that you can organically become more aggressive with more confidence rather than leveraging up and shooting from the hip at every trading opportunity that you're presented with. That's not masterful trading. And I definitely want you to write this down. If you cannot measure it, you cannot master it. If you cannot measure it, you cannot master it. I am blown away by how many traders just don't journal their trades. Where do they think they're going? What do they think's going to happen? As their edge starts to deteriorate, then what? You got to start from square one because it could be so many things that are changing and you're not documenting. And now all of a sudden, instead of tweaking something that's been highlighted by your money management spreadsheet, now you've got to start again. You've got to reinvent the wheel. So the amount of times I ask people to send me their thing and they can't, send me their journal and they can't, is shocking. So let's talk about journaling first then. All right, because there's some very basic principles, as I just said, that are really ignored by rookie traders. And they're usually around expenses and income, which is essentially your P&L, okay? So any good business, regardless of the trading business, understands that expenses and income and the ability to also replicate a system that works to create ongoing profit is very important. All right, and the way that you have to do that is to journal your trades. You have to journal your trades. And for some of you, it's going to feel like I'm teaching you to suck eggs, but I'm going to give you some pointers on what I recommend you start journaling, because there's a lot of new guys here, right? And I want to tell you what I would recommend as a minimum that you journal, and then some advanced features as well. So get a pen, get a bit of paper, and write these down. If you're going to go and backtest the system, or you're journaling, and many of you are backtesting, or you're thinking about backtesting, first thing you want to note down is the market symbol. Okay, so what market you're trading. Aussie CAD, Aussie dollar, pound dollar, gold. What is the symbol? Is it Apple, right? The next thing is the trade size, so the amount of capital that you're trading, the direction of the trade, long or short, what price that you got in at, so the entry price, what price you got out at, the exit prices, and obviously that could be a stop loss price or it could be a target price, hopefully a target price. Hopefully you got more target prices hit than stop loss prices hit. The next thing is the time and date of entry or exit, and that's a really important one. There's been times where I've done some testing and I haven't noted down the date. This is very early on in my trading journey, and when I wanted to go back and do some tweaking or changing to that system, I couldn't find any of the trades. I had to scroll back and I basically had to do it all again. It's very important when looking back over and analyzing your system performance in your journal trades as well. Definitely don't skip that. The time frame that you're trading it on, the profit and loss, what the P&L was, account size before and after the trade. I always like to note that separately. The setup, okay, so the reason for entry, was it a flag pattern? Was it a breakout and retest? Was it a double top? Was it a bat pattern? The trade management style, so how did you manage the trade? Was it trailing stop? Was it a lower time frame management? Was it the profit target, limit orders, however you're managing the trade, how did you manage it? And then any other notes that you might have. Okay, so notes, did you feel emotional? Did you feel, was there something going on? Was there something untoward? Was there high impact news releases or anything like that? Any other notes that you want to add, it definitely pays to add that into your back testing. Okay, so that's the minimum that I recommend that you do your journal, take consideration in your journal. Now, there's some advanced ones. And I've mentioned some of these throughout this workshop already. The third is preferred analysis. I mentioned this yesterday. Okay, preferred analysis. You want to see it again? Here you go. You can screenshot this or take a photo of it with your phone or whatever it might be. Okay. So the first advanced one is preferred analysis. So you might have a certain bar or candlestick formation you look at. Remember we spoke about this when we was developing a system yesterday? You might have a tweezer top or a 3-bar reversal, something where you go, that is something I prefer to get on this setup, like I showed you with the Aussie dollar yesterday. You might use multi-time frame analysis. You might have a higher quality trade based on higher time frames. You might use an indicator setup like a MACD or an RSI, or you might look at divergence, or you might use pivot levels or certain price points, or you might use Fibonacci, as Akil was demonstrating yesterday as well, or earlier today. So that's preferred analysis. You want to journal any preferred analysis. Then there's qualitative analysis. Okay, so as I said yesterday, this is the number of tests of major support and resistance touches. It could be greater reward to risk profiles, so a 3-to-1 instead of a 1.5-to-1 or something like that. It could be risk reward based on where price is likely to go to the next major support or resistance level. So how much room you've got to profit, to squeeze profit out of it. That's qualitative. Then there's untriggered entry orders. Okay, orders that were set up and just didn't get filled. They were slipped orders. You definitely want to journal those. Don't just wipe them off and forget about them and go, post a picture on Twitter. Look at this, I didn't get filled. How annoying. Actually journal those trades and write them down as a zero trade, but they're in your journal because they're going to be important in a moment. And the next thing is emotions, how you were feeling. Okay, how much fear you had on entering the trade from 1 to 10. I always like to give things numbers and priorities and like tangible metrics. So if you're feeling fearful, don't just say, I felt fearful for taking a trade. Score it. Score it from 1 to 10. And also, how much were you chasing the trade? So greed, fear and greed metrics. On a scale of 1 to 10, how badly did you want to get into the trade? And on a scale of 1 to 10, how badly did you not want to take the trade? And start scoring that stuff, because that's going to give you some real insightful patterns. You guys know I'm obsessed with patterns now and priorities. I don't like things left to chance or emotion. It has to be black or white. As I say, you can't be half pregnant. So basically, this is a great way of measuring some metrics on your confidence or reluctancy to take a trade. Make sense? And it's a great metric to have. Next thing is evidence. So take a screenshot or a video of the trade and then put that link image to your database or your journal, whatever you use. Okay, I use Notion and I use Google Sheets. I know other traders, I think Naomi uses Excel, but she's got a great way of posting the screenshots into Excel. People do it in different ways, but definitely you can use Loom. I don't know if you guys know Loom, but you can record your screen. It's really powerful. Camtasia, things like that. Loom's great because it just stores it as a URL and it's not on your computer. So you can just immediately get the link, put it in your spreadsheet, and you've got the evidence there to go and review it later. Accumulating performance. So I suggest keeping a record of your last 10 trades, okay? Or it might be more than 10 trades, it might be less than 10 trades, but basically the last kind of week to 2 weeks of trades in a separate section of your journal. And I'm going to talk a little bit more about this in shortly, but it's basically a way of checking your latest performance. Your latest performance, and that's going to be more important in a moment when I explain why. And then have a grading system. If you guys have read any of like Mike Bellafiori's books, or you've heard any professional traders speak, they talk about a grading system, an A+, B, C, D setup. It's great to have a criteria. We use the CTS system, so you could have a point scoring system. And from these records, your data can be analyzed properly, and therefore it will give you the ability to assess your trading business properly and see the best performing strategies, the best performing instruments, the average profit per trade, the average trade duration, the win-loss ratios, the account equity curves, and lots more. And that's really going back to day one when we did the trader assessment. And some of you said, I don't know my win-loss. I don't know the amount of monetary or pips gain in any 1 week or month. You didn't know that stuff. Okay? So one thing I'll say, I can see some people typing in about automated. Look, there's some great automated journals out there, but I always say this, before you consider using one of them, I would say don't use one if you're too lazy to record your data manually first. All right? Now, if you've developed enough consistency to take a step back from the manual approach and you're seeking maybe some deeper analytics in your data analysis, or you're in the fine-tuning stages of a strategy, like every Christmas I do a ton of testing, I could happily use one of those softwares, okay? Because I'm in the higher stages of strategy development and tweaking. I would say then you could consider them. But if you can't be bothered to analyze each and every trade in depth, then don't even think about moving to them softwares. Don't even think about it. It's pointless. Because you're not going to be connected to the numbers. And I can't, honestly, I know you're not going to believe me, many people, but I can't emphasize the importance of being connected to the numbers, putting the work in. One of our traders on the accountability session last week said, you can't skip the grind. You can't skip the grind. There's no way. There's no shortcut. Excel's good. I use Google Sheets because Google Sheets just is cloud-based and I think it's great. But yeah. So let's talk about frequency because people are saying how often. I think there was a question from Chris saying how often. If you're manually journaling, okay, ideally you want to be recording as you trade. So take notes of any relevant data by copying it straight into your journal. And if an entry triggers, you might start recording that data for the trade immediately. If you adjust profit targets or stop loss during the trade, you might log that immediately. Or when a trade closes, you then kind of complete the entry of the trade. So I would say try and do it as you're trading, because that way it's going to be as kind of as realistic and as accurate as possible. If you're using automated journaling, I would definitely say you want to do it as minimum of once a week, ideally after every trade closes though. So I'd always say, you know, as you're trading, you want to journal. It's the best way to do it. It's the best way to do it. For me, manual is key, but there's certain things that you can't do. Excel for calculating numbers are awesome. Also good, do it quick as you remember emotions. Yeah, it's always best to do it as you do it, right? All right, figure focus. Knowing your numbers and projections, what to focus on and what not to focus on. So we went through this little table yesterday, but what I'm going to talk about is most rookies, they focus on their account balance. All right, and one of the first things I learned in trading was that in the short term, it's very wise to ignore the small fluctuations in your account balance. And I know that, of course, it's going to feel uncomfortable to ignore your balance at first, but it will dramatically improve your consistency. I remember, you guys remember when we used to work with Trade Empowered, and some of you know Jason, he used to put a post-it note on his screen. I remember he used to say, put a post-it note on your screen. And honestly, it will dramatically improve your consistency if you're not focused on the money. All right. The issue that you'll have constantly, and let me know if you do this, guys. The issue that you're going to have concentrating on your account balance is that it shifts your priority towards making money instead of sticking to your strategy and not losing too much on any one trade. And what did I say at the beginning of this session? I said cash is king. Rule number 1, don't lose money. Rule number 2, see rule number 1. You want to focus on not losing money before you focus on making money. Because if you can focus on not losing money, you will inevitably make money. All right? Your trading plan, which you now know about, should always be your guide. And making money is merely a side effect of following your trade plan, your sound trade plan. All right. Now, depending on your level of attachment and emotion, and I know people have really struggled with this in the past, you can hide your balance from your platform. You can just take that off or minimize the column or whatever you have to do, put a post-it note on there. And it's not just losing drawdowns as well, but it helps balance out cockiness as well when you're in a winning streak. You know, if you've hit a big winner, I did this last year, April the 3rd, 2020, hit a big winner. You know, if I was sat there staring at my balance, that would affect me. It would affect my trading decisions. So don't focus on your account balance. The next thing is don't focus too much on profit and loss. Okay, now naturally you want to see profits, of course. But without putting the figure into perspective, by using percentage growth, what it leads to in particularly new traders is either kind of an undue disappointment or an undue euphoria. Now, one trader, I told this story before, but one trader told me that they made $1,700 profit in their first 4 months. And that represented about an average of about $9,800 of profit per week. And when he told me this, he was disappointed and frustrated because he'd been following all the rules and he was deflated that he had made $1,700 profit in the first 4 months. And the thing is, he only started with a $4,000 account. So essentially he'd made close to 10% per month, which was, you know, phenomenal. I doubt that he was sticking to his trade plan. I think it was too volatile, too much risk on the table there, and he maybe got a little bit lucky. But because I made him see it in terms of percentage, he was a bit more uplifted. Because if you focus on percent, if you can make 2, 3, 4, 5% per month on a 5,000 account, then you can also make 2, 3, 4, 5% on a 7-figure account or a 6-figure account. So you want to focus on that. And that leads me to the next point, which is think in terms of annual or monthly percentage returns, not monetary value. Because the skill, and you have to understand this, the skill required to generate 4% monthly on a 50 grand or even a 5 grand account is virtually identical to the skill required to generate 4% monthly return on a 500 grand account. The skill's identical. It's no different than playing, you know, learning to play the guitar and then playing a bit of a faster song using the same chords. It's really, the skill is still the same. The skill's the same. The intensity's a little bit heightened, but it's the same thing. So set long-term goals, believe in your own ability to generate the account equity that you need to build a significant and stable trading portfolio account. And you focus on the returns in terms of percentage, and you hide your balance, and you don't focus on the money, you focus on the percentage returns. All right, so now we're going to talk about self-review. And I've got a little bit more to cover here, so hopefully we're all right for time. It's my turn to go over. I'm always on time. So self-review, what this is about, and it's really important, this is about becoming more efficient and more effective in everything, including your trading executions, your mindset, your emotions, your profits, and your overall performance. Okay? Understand that having emotional issues is a lack of efficiency. You guys might have heard me say that before. And this is something that's skipped and ignored by many, many struggling traders. But I tell you now, it is adopted by elite traders. It's adopted by elite traders. The best traders that I've ever seen adopt this. And you want to become more efficient and more effective. If you're wondering the difference between efficiency and effectiveness, the way I was always taught by a guy called Peter Drucker was efficiency is doing the thing right, and effectiveness is doing the right thing. Okay? Efficiency is doing the thing right, effectiveness is doing the right thing. So I want to cover 3 things here. First of all, excessive loss. Okay? So this is where you want to be journaling and reviewing incorrect trade size on the position where you've carried too much risk on the trade. So for example, if you've got a risk management strategy that means you can only have a maximum risk of 0.5% or 1% on any one trade, let's just say 1% and keep the maths easy, all right? That means that you'd have to go through all the trades where you've lost more than your maximum allowable, which in this case would be 1%. So in this example, I've said trade 1 in my journal and trade 7 in my journal. I lost 2.5% and 1.5%. Okay, so any trade that I lost more than 1% on. So what you want to do is add up the total loss from those trades. And that means that had you executed your trade plan flawlessly, you would have been 2% up in this case. 2% up. 2 trades with 1% risk on each, right? And then you subtract the error. And then you have something to know that by taking excessive loss, you know how you're deviating from trading your plan flawlessly. That's excessive loss self-review. Okay, you've lost 2% as a result of incorrect position sizing. So what you want to do is you want to have a separate column and you want to add lost from fault and gain from fault, and you want to add these in. The next one's execution error. You guys know I've spoke about this before. This is where you go through every single trade that you entered into your journal and you ensure that they were legitimate entries based on your trade plan rules. Okay, so this is what reviewing the tape is really good for doing this. Some of you have heard of reviewing the tape, or looking at your videos from a third person after you've done the trade and your emotions removed. You watch yourself, how you traded, and you compare that to your trade plan rules, and you want no execution errors. So you literally open your trade journal, look at the first trade that you recorded, bring up the chart for the market after it's done. You take note of the date you entered the trade, the time, strategy, the trigger of entry, and then you compare it to the relevant chart and see if it was in fact a real entry. Okay, you can use your strategy checklist or whatever how you enter your trade plan rules to confirm or reject whether the trade was a valid trade. All right. Now, this might seem a bit pointless and time consuming to people, but I tell you now, it will blow your mind with how many trades that you entered that didn't actually meet your strategy requirements. The magic of looking back at your trades in hindsight is that you've lost the emotional connection to the charts and the strategies. And that means you can actually see things differently. You're more objective. You're more logical. Okay? And then what you want to do is, if the trade was valid in hindsight, give it a tick. If the trade in hindsight was invalid, give it a cross. And then, of course, for all the invalid entries that you lost money on, add up the total and add it to your loss from fault tally. And all of the trades that were invalid that you made money on, add up all the total percentage profits and then add them to your tally gain from fault. All right. And on that note, I want to say, because you can have invalid trades that make you money, and that isn't something to celebrate, because you broke the rules and failed to trade flawlessly. And a good trade doesn't necessarily make money. And a bad trade doesn't necessarily lose money. Definitely write that down. A good trade doesn't necessarily make money, and a bad trade doesn't necessarily lose money. Okay, so the purpose of this self-reviewing process is to calculate exactly how much money you are making and losing compared to the pure strategy performance. If it was traded flawlessly. And as I said yesterday and the day before, if anything, you want to lower your expectations, not raise them. All right. So again, you add them up, you tally them up, and you add them to the one from fault or loss from fault. Next thing's missed entries. So far we've got your journaling and checking, trades with excessive loss, trades of execution error, and trades that you've missed. Now, I can tell you that some of the most costly trading mistakes don't come from what you do, but rather what you don't do. And that's missing a trade. Missing a trade can cost you 2%, 3%, 4%, 6% on missed profits, depending on the kind of move that you miss out of. And this is the most common with new traders. Missing trades. When they go live, they miss trades. And that's sometimes down to error, like order execution error or slippage or something like that, or they didn't quite get the order on right. It's very common. So this is where, again, you open up your charts, you start at the first market that you trade in your plan, you analyze the last kind of 10 days or 2 weeks, basically the period you're conducting the review on recently, usually in batches of trades, and you check any setups that occurred. You go back to your journal and make sure you took the trade, and if you did, then great, move on to the next pair until you go through the whole portfolio of your journal. And if you miss some trades, again, write down the gains from fault and the losses from fault. Okay. Now, once you've done this, you've got a comprehensive list in your journal of errors, right? How much you've won and how much you've lost from trading. Agree? So a great thing you can do, there's something called net performance discrepancy, and this is total gains from fault minus total gains from losses, and that equals a net performance discrepancy. Okay, now the problem with that is, and this is very, very straightforward maths, by the way. You know, if your result comes to, -2, you've essentially realized a 2% loss in your account, which is entirely attributable to your own human error. All right. But the thing with this is you'll get to a situation sometimes where your total gains from fault are equal to your total losses from fault. And that basically produces a net performance discrepancy of 0. And that gives you a false sense of security because you actually think you're doing well, because you want to approximate 0. So net performance discrepancy is an indication that your total profit and loss is equal to that of your strategy's true performance. Okay, however, to calculate the total magnitude of your own personal errors, it's better to use what we call a gross performance discrepancy. And a gross performance discrepancy is basically where you convert all of the plus and minuses to a plus figure, okay? And basically that will give you a true representation of how far you have deviated from becoming a master trader. Take the absolute value, yeah. Okay, and you want to approximate 0. You want to approach 0 gross performance discrepancy every single month. And that's your only job as a trader. Yeah, the gross performance discrepancy can't have a negative answer. So you add them all up. So I've got some examples here. Maximum loss from fault, 0.5, invalid entry, 1%, etc., etc., etc. Comes to 4.7. That's your gross performance discrepancy. So that's how to use both of those. All right, so hopefully that made sense. This is like gold dust, this information, and you probably won't find anyone else talking about this. I think Chris just said this is, I've never heard of this from other systems I've purchased in the past. Wow. Amazing. This is what's going to be the differentiator between your trading through what you're learning here and what you'll learn anywhere else. You take note of this stuff and you can't help but become a better trader. So with that said, I'm going to wrap up right there. Hopefully you got value from that. Tomorrow we're going to talk more about the numbers. We're going to show you some money management as well. But we're going to go back to Charles. We're going to take a quick 10-minute break. Let's come back at 20 past. Is that okay, Charles? 20 past the hour. And if you've got any questions on this, guys, fire in, and we're sat here ready to answer questions as well. So I'll see you in a minute.